Hello friends, welcome to IAS ABHIYAN YouTube channel. In this video lecture series, we will discuss on important economic terms that is often seen in news. Our first important economic term is ways and means advances. Ways and means advances are temporary loan facilities provided by the RBI to the government to enable it to meet temporary mismatches between the revenue and expenditure. The government makes an interest payment to the central bank when it borrows money. The rate of interest is the same as the repo rate, while the tenor is 3 months. The limits for ways and means advances are mutually decided by the RBI and the Government of India. So basically, ways and means advances are temporary loans facilities provided by the RBI to the government to enable it to meet temporary mismatches between revenue and expenditure. Next economic term is marginal cost of lending rate, that is MCLR. Marginal cost of lending rate is the minimum interest rate that a bank can lend at. It is a tenor linked internal benchmark, which means the rate is determined internally by the bank depending on the period left for the repayment of a loan. MCLR is closely linked to the actual deposit rates and is calculated based on 4 components: the marginal cost of funds, negative carry on account of case reserve ratio, operating costs, and tenor premium. The Reserve Bank of India introduced the marginal cost of lending rate methodology for fixing interest rates from 1st April 2016. The marginal cost of lending rate replaced the base rate structure which had been in place since July 2010. Next economic term is long-term repo operation. Long-term repo operation is a tool under which the central bank provides 1 year to 3 year money to banks at the prevailing repo rate, accepting government securities. How it is different from liquidity adjustment facility and marginal standing facility. While the RBI's current windows of liquidity adjustment facility and marginal standing facility offer banks money for their immediate needs ranging from 1 to 28 days, the long-term repo operation supplies them with liquidity for their 1 to 3 years needs. Long-term repo operations are intended to prevent short-term interest rates in the market from drifting a long way away from the policy rate, which is the repo rate. Long-term repo operation helped RBI ensure that banks reduce their marginal cost of funds based lending rate without reducing policy rates. Long-term repo operation also showed the market that RBI will not only rely on revising repo rates and conducting open market operations for its monetary policy, but also use new tools to achieve its intended objectives. So basically, long-term repo operation is a tool under which the central bank provides 1 year to 3 year money to banks at the prevailing repo rate, accepting government securities. Our next economic term is a very important term that is often seen in news. It is repo rate, that is repurchase rate. Repo rate or repurchase rate is the key monetary policy rate of interest at which the central bank, that is the Reserve Bank of India, lends short-term money to banks, essentially to control credit availability, inflation, and economic growth. Repo rate in India is the primary tool in the RBI's monetary and credit policy. Other policy rates such as reverse repo rate, marginal standing facility rate are often directly linked with the repo rate of RBI. The RBI governor presides over the meeting of the Monetary Policy Committee, wherein the repo rate for the following term or the current repo rate is decided. In the event of inflation, central banks increases repo rate, which ultimately reduces the money supply in the economy and thus helps in arresting the inflation. Reverse repo rate is actually the opposite of repo rate. The RBI borrows money at this rate from the banks for the short term. In other words, the banks park their excess funds with the central bank at reverse repo rate for 1 day. The banks earn an interest rate on government securities purchased from the RBI for the given period. The repo rate always stands higher than the reverse repo rate, and the spread between the two is RBI's income. An increase in the reverse repo rate will decrease the money supply and vice versa, other things remaining constant. An increase in reverse repo rate means that commercial banks will get more incentives to park their funds with the RBI, thereby decreasing the supply of money in the market. So basically, reverse repo rate is actually the opposite of repo rate, where RBI borrows money at this rate from the banks for the short term. Repo rate is always stands higher than the reverse repo rate. Next economic terms are overnight repo and term repo. Apart from reverse repo rate, some of the other types of lending and borrowing under repo rate are overnight repo. What is overnight repo? A repo transaction for a day is known as an overnight repo. In such an agreement, banks sell securities to the RBI for money and repurchases those the following day, thus returning the money to the central bank. Next is what is term repo. Term repo includes a period of more than 1 day. The usual duration of term repo or variable rate term repo is 7 days, 14 days and 28 days. The RBI normally announces the term repo auction as and when there is a need of funds by the banks for a duration of more than 1 day. So overnight repo, it is a repo transaction for a day, and term repo includes a period of more than 1 day. Next is commercial paper. Commercial paper, also called as CP, it is a short-term debt instrument issued by the companies to raise funds generally for a time period up to 1 year. Commercial paper is an unsecured money market instrument issued in the form of a promissory note, and it was firstly introduced in 1990. Commercial papers have a minimum maturity of 7 days and a maximum of up to 1 year from the date of issue. However, the maturity date of the instrument should typically not go beyond the date up to which the credit rating of the issue is valid. Commercial paper can be issued in denominations of ₹5 lakh or multiples thereof. Since such instruments are not backed by collateral, only firms with higher ratings from a recognized credit rating agency can sell such commercial papers at a reasonable price. Basically, commercial papers are usually sold at a discount to their face value and carry a higher interest rates than bonds. So, commercial paper is a short-term debt instrument issued by companies to raise funds generally for a period of 1 year. Next is a futures contract. A futures contract is a standard contract to buy or sell a specific commodity of standardized quality at a certain date in the future. For example, if oil producers want to sell oil in the future, they can lock in their desired price by selling a futures contract today. Alternatively, if consumers need to buy crude oil in the future, they can guarantee the price they will pay at a future date by buying a futures contract. So it is nothing but a standard contract to buy or sell a specific commodity or standardized quality at a certain date in the future. Next economic term is special drawing rights. Special drawing rights is an international reserve asset created by the International Monetary Fund in 1969 to supplement its member countries' official reserves. The value of special drawing rights is calculated from a weighted basket of 5 major currencies. They are US dollar, the euro, Japanese yen, Chinese renminbi and the British pound. Technically, the special drawing rights is neither a currency nor a claim on the IMF itself. Instead, it is a potential claim against the currencies of IMF members. Special drawing rights serves as the unit of account of the International Monetary Fund. Special drawing rights can only be held by IMF member countries and not by individuals, investment companies, or corporations. Special drawing rights are used by the IMF to make emergency loans and are used by developing nations to shore up their currency reserves without the need to borrow at higher interest rates or run current account surpluses at the detriment of economic growth. Okay. Next economic term is open market sales scheme. The open market sales scheme refers to selling of food grains by government or government agencies at predetermined prices in the open market. The scheme aims to enhance the supply of grains, especially during the lean season, and thereby to moderate the general open market prices, especially in the deficit regions. Next, it's a green bonds. Green bonds are debt instruments issued by financial, non-financial or public entities where the proceeds are earmarked for use towards financing green projects. India's first green bond was issued by Yes Bank Limited in 2015. India's first listed green bond on India INX issued by Indian Railway Finance Corporations. Thanks for watching.